Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again an old friend, Peter Grandich. Peter and I go back, I guess, probably a couple of decades, and I hate to admit it, but it's probably true. But the thing that I consider Peter one of my better friends in this industry. He's certainly one of the more honest people that I know in this industry. And honesty, well, we talked last week to Dr. Robert McHugh, who is definitely an honest person. Dr. McHugh has a formal education. He's, I think, very, very good technical analyst and very strong moral character as well as Peter. But Dr. McHugh has a more formal education. Peter comes without that formal education, but sometimes I really believe that the people with the more formal educations have more difficulty in assessing what truth is because they've been fed a lot of propaganda to get their degrees. They have to give the teachers, the professors, the right answers according to what is politically correct, not necessarily according to what is true. And Peter, without that, though, has, I think, an uncanny ability to see truth, and he has never been shy about telling people what he thinks, and so that's why he's so valuable as a guest. Welcome, Peter. It's really good to have you with me again.
It's always a pleasure, Jay. Thank you for having me.
Oh, it's great to talk to you always, and I'd like to just maybe you can update our listeners and tell them what you're doing these days, because you've had a lot of different things you've done through your professional life.
That's correct. At the beginning of this year, I ended publishing the Grandich letter that started back in 1984, and stopped working in the resource market to focus almost full time in a business I've had for about 13 years down here called Trinity Financial Sports and Entertainment Management. It's a Christian-based firm specializing in business, retirement, and estate planning, both for professional athletes and the general public. My one foot still in the water, so to speak, is I'm still I do market commentary for MoneyTalks.net, which is based in Canada. And last but not least, I spend a lot of time in Christian sports ministry. So that's really where I spend most of my time now.
Yeah, it's very interesting, Peter. I think you have some attachment perhaps to the New York Giants, if I'm not wrong, and also the New York Yankees. Is that right?
Yeah, it's not the best years to say that because they didn't have great years or having great years, but almost for 10 years now I work doing both Bible study and chapel services for the Giants and on a lesser times with the New York Yankees.
You know, I can understand why the guys in professional sports in the NFL. I mean, some people have said it's sort of America's bread and circus in a way. It's a gladiator type of sport. I watch some of these guys, Peter, in slow motion when they get hit. You know, when they do a replay and they see their bodies just getting the punishment they take. It's not hard for me to understand why some people might be looking to some answers outside of time and space for their. When they have to face that kind of punishment, that kind of danger.
Yeah, well, I deal a lot with retired athletes, and many of the athletes I deal with played in the 70s, 80s, and 90s, and almost to a man, they are suffering substantial physical debilitating injuries, a lot mental, and, of course, financial as well. Most players, particularly in football and hockey, didn't really reach what we would call big paydays until the last 10 years. So the players certainly back then made more than the average person, but they didn't make the money that basically you put it in the bank and you sit on your tushy for your rest of your life. And the conditioning that they had back then and the equipment they used was also inferior. So there's a lot of debilitation, and there's a lot of proof now of, now the first focusing on all this concussion stuff. But it's really sad to see what we, like you said, we're basically gladiators, can hardly walk and talk at this point.
Yeah, I think somebody said recently in the NFL, the injury probability is 100%. So for guys that are playing in the NFL, maybe just for the interest of it, could you tell our listeners some of the players that you've become fairly close to? A lot of pretty well-known professional athletes. Who are some of them, Peter?
In our advisory board, because we're New York, New Jersey based, it's predominantly New York athletes. I would say probably the more recognized names, certainly from the New York Jets, my hero and good friend and someone I think that's finally going to be justified and put in the Hall of Fame, Joe Klecko. From hockey status, Ron Greschner, Ken Danico. We have a array. We don't discuss our current clients' names. That's one of the confidentiality things that we do. We currently have 23 NFL players as clients, and it's an interesting thing. My partner is a former two-time New York Giants Super Bowl player, and he likes to say that the NFL stands for not for long. And people don't realize for every star that you've seen and it looks like they've done well, there's about 30 or 35 guys that stay around not even enough to qualify for the pension, get pretty banged up, and then their health benefits run out. And now we're seeing what happened to guys like that 10, 20, 30 years ago. They have enormous injuries and problems, and unless they got a very good job, which carry a lot of great health benefits, their injuries from 20 or 30 years ago have really made them pay a big price.
Yeah, well, I can imagine that. I mean, I've had a boyhood friend that I grew up with up through early grade school who went to Ohio State and played for the Ohio State Buckeyes as a center, the starting center in his junior and senior year. Was injured when tackling O.J. Simpson in the Rose Bowl, actually. And I know I talked to Johnny recently, and he was having all kinds of knee problems and different problems. So that's the way it is. I mean, people go into that sport knowing it, I guess, but it is really quite debilitating. But anyway, you're doing good work, Peter, and I know what I'd like to get to now is for you to tell us what you think about this amazing bull market in stocks. And we're going back to 2009, and you called it right. I remember meeting up with you in Vancouver, sitting in on one of your sessions, and you were telling people, and I was as bearish as could be still. It was probably around March of 2009 or something like that, or January of 2009. You were turning bullish. Now we've had quite a run. How much further can this thing go?
Well, because I've had such a life and resource and was wrong there the last few years, people seem to forget the market call. I do appreciate it. You're right. When the financial crisis started in 2007, got very bearish, and in March of 2009 said that we were going to have the greatest market rally ever, and targeted way back then somewhere around 16,300, 16,500 on the Dow. Spoke about a megaphone top that needed to be put in place, but began this year turning bearish in the sense that we said I like to use the first half of the year for people to move and greatly lower their exposure to general equity. I'll put it very simple. You started at the onset that I'm not an educated man in the sense that I spent a lot of days in school, and I agree with you fully. I thank my on-the-job education. I believe I understand things better than the academic who went to Wharton Business School and was taught a lot of numbers that really don't work in the regular world. But nevertheless, my feeling here has been that we have really been on a cocaine high, and the cocaine is the Federal Reserve, and so long as they continue with what I think is going to have to be QE 5, 6, 7, and 8. The market has become accustomed that somehow it only has one direction. And what's been lost sight, and you spoke about how far we went back. You and I actually go back, believe it or not, to 1989 was the first time we ever did a seminar together. So if you can imagine, that's 25 years ago.
Yeah.
When we go back to those days, Jay, the stock market was what it was supposed to be. It was pretty much a market for part ownership of businesses. About 85% of the trading on the New York Stock Exchange was individuals, and people were buying stocks because they wanted to be part owners of companies.
Yeah, they were investors.
That long ago disappeared. The vast majority of people that are participating in the markets, many of them don't even know what the name of the company or what it does. It's because it shows up on some computer program. And because of that, people have lost sight and now think that so long as the Fed is acting in one way, the market can only go one way. And I think they're going to be in for a very big disappointment. I believe we're forming a massive, massive top that's taken many, many months to take hold. And when the final top is in and we go down, it's not going to be down for 6 months or even maybe 6 years. It may be down for a generation.
Well, you mentioned the megaphone top. That's something that Dr. Robert McHugh talked to us last week about. He sees a gigantic megaphone top, or he calls it the jaws of death, because of the serious problems that arise when you have a massive decline in the equity market. You're seeing this megaphone top, and a major one as well?
Yeah, well, I don't believe there's a crash, because I think some of the things that have caused crashes before won't be in the same place to do that. Although I do like to go back to a week ago Wednesday when we opened down 400 points, and one of the Fed persons had to come out and make a mention as if, well, maybe we don't have to raise interest rates, and that suddenly a surprising number of people showed up in the index futures and drove the market up. That goes back to an incident. I don't know if we have time to tell about it, but what actually happened when my claim to fame started in calling the 87 crash.
Yeah, let's talk about that, because when you called that crash, I guess you ran into some trouble with your boss at that time for saying things he didn't want your clients to hear. Yeah,
it's actually been my prescription for people to understand why the coinage that I've called the "Don't Worry, Be Happy" crowd on Wall Street exists, because it was explained to me perfectly at the time by the chairman of the New York Stock Exchange company I work for. So it's August 87. I put out a forecast for a crash. The very next day, I'm called up to headquarters. I'm told to either retract it or resign, and I asked why. And in a nutshell, what the chairman said was this: listen, 90% of our clients are not going to sell everything as you just advised in your opinion. And if they did, and you're wrong, which we think you're going to be the laughing stock to them. And if you happen to be right, and it does, and they don't listen to you, they're going to be in such a bad way it won't matter what you say after that. So let's look at the 10% that did listen to you and sold everything. I suspect that half of them will be too petrified to go back in when you tell them to go back in. And then he said the classic line that has stuck in my mind forever, and that was, Peter, we can't exist with only 5% of our clients benefiting from your advice. From a pure sales standpoint, he made great sense. It'd be the same as if the Archangel Gabriel showed up at all the chief market strategists' homes tonight and told them God has foreseen a 5,000 decline point in the Dow next week. Even if their hearts took it and believed it and went into their offices tomorrow, I'm convinced that the people that are in charge would never let them broadcast it. It's the same as if I went down to the Chevy dealer and I said I wanted the fastest car, and the Chevy dealer knew it was actually a Ford Mustang. There's no way he's telling me to go down to the Ford dealer. He's going to sell me a Camaro. Yeah. So the bottom line is, on Wall Street, I don't think we could ever get truly objective advice, because it's a sales organization, and there's nothing wrong with that. That's what capitalist society is about. But we see a constant parading of just the spokespeople for these organizations through much of the financial media, and the types of objective third parties who are willing to go against that and are willing to say that sometimes maybe you shouldn't be in the market or you should be in cash or something. You just couldn't last or work at those firms. So I don't believe the average person can get truly objective advice if they just stayed and listened to the general financial media on most of the typical places we know. I call one Tout TV. But in general, I think financial journalism is as tilted as the Wall Street itself when it comes to viewing one way. That's why if you ever look at model portfolios from all these firms, it's always just divided between stocks, bonds, and cash. And you and I both know there's been many, many times throughout history when any one of those or all two or three of those may have not been the best thing, yet that's all that they have their people in, because that way they keep the money captured and earn their income off of that.
Oh, no question about it. And but Peter, it seems to me also the fact that we have moved from a manufacturing economy in which people actually produce things of value to more of an entertainment economy, and one that's not really based on sound money. It's based on fiat money, and so the people that control that fiat money system, the government and Wall Street, essentially the bankers, want to keep this game going. They want to keep people in paper assets and the stuff that they can create out of thin air, essentially. And it seems to me that the importance of the economy, of the stock market to the economy now. I used to be, the economy was the main thing that we were concerned about, and the stock market was a reflection of the economy. Now it seems as though the tail is wagging the dog, almost as if the economy depends, and this seems to be what the Federal Reserve does, because whenever there's a, as David Stockman calls it, the market throws a hissy fit, as they did just a few days back, the Fed comes out and says, "Oh, never mind, we'll keep QEs coming at you." So it seems to me that it's not the same as it used to be. You mentioned back in the days when you and I first met, and earlier than that, I would argue, 1987. I think you would agree is probably a tipping point when the plunge protection team came into being, and your friend John Krudels talked about that recently. Would you care to just what's your view on that?
Well, what John brought up, John Crudell is one of the very few financial journalists who aren't part of that "Don't Worry, Be Happy" crowd.
Right.
And it was, people forget that while there was a crash on October 19th, 1987, October 20th was set to be a much even darker day. After the 19th decline, we opened up again substantially lower, and by early afternoon, just about 12:45, I remember, 17 of the 30 Dow stocks had still not opened on the New York Stock Exchange.
Wow.
They shut the Chicago Board of Options Exchange S&P futures pit, but they kept a very small trading contract that traded on the Kansas City Board of Trade open. And around 105, between 105 and 120, 13 of the biggest known financial institutions decided, coincidentally, to go to the Kansas City Board of Options Exchange and buy index futures to the point where in 20 minutes it drove indexes up equivalent 1,300 Dow points.
Wow.
And that quickly opened the rest of the Dow 30 stocks and all other stocks on specialists that couldn't open them. And we finished up about 170 points that day. But that's how close we came. And so when we saw the other day when we were down 400, and in a very short few minutes, we turned dramatically up after a bunch of index future options were bought, John wrote about, the plunge protection team looks like it was put into action again. Mm-hmm. And let's understand this, and, when the naysayers and the people that say, oh, there's no such thing as conspiracies and all of that, we know governments that openly intervene in the markets. Japan has been a notorious country that openly has intervened. And why they think that somehow we don't do it, just like we've read in all issues of all sorts of charges in all sorts of markets and people found guilty, most recently in the LIBOR scandal, and somehow people think when it gets to the COMEX, it stops there, that somehow that doesn't happen there. Markets are manipulated all over the place, and I believe governments participate in them too. And it's just become, unfortunately, an acceptable practice, and I don't think there's anybody strong enough or willed enough that could change that.
No. Well, but you would agree that it is a growing phenomenon, Peter, and it seems to me that the more intervention there is, the more that's required down the road because markets aren't allowed to self-adjust. Would you agree with that?
Well, what I do know is this. If I had a child and when he left my house, he had a lot of money, and by the time he came back, he was dead broke and owed a lot, I'd be very unhappy with him. Well, the United States in our generation, yours and mine, has gone from the largest creditor nation to the biggest debtor nation.
Right.
So I don't know how these guys still come out and say America's greater than it's ever been, et cetera, et cetera.
Yeah.
And the problem with that is, and it's an old story, and I've talked about this quite often, my poster child for what's wrong in America is public storage. Our parents never needed public storage. There weren't 5,000 square foot homes down every street. There was only the very wealthy that had homes the size of that. They didn't need all this stuff now that we have so much of that we have to pay people to keep it in storage for us besides in our own homes. And we've become a society of consumption. You brought it out. We have gone from a very strong manufacturing society and nation to a consuming, lower income, entertainment type of stuff. And what's happening is people say, well, look, the oil price came down, great saving for consumers. Do you really think America's going to take that saving and say, you know what, this is a good time for me to pay down my debt? No, they're going to take whatever money they saved on gas and spend it someplace else.
Right.
And that's the unfortunateness. And one other thing I think is a very missed point that isn't spoken of, Jay. Where is it that the Federal Reserve is supposed to be in charge of our economy? Where has fiscal policy been, not just in this administration, but going back 2, 3, 4 administrations? You talk to business. I deal with business people from small mom and pop stores to, 400 or 500 million, even, close to $1 billion businesses that are privately owned. And what they say almost to a man and woman is, never has it been more difficult to run and own a business in America it is right now. And Washington has just been totally abyssed in terms of any real new fiscal policy, and this next election is only going to make that worse. There's going to be more of a polarization. There's going to be less of a willing for both sides of the aisle to walk together, and the Federal Reserve has taken upon itself, and now everybody thinks that the moment there's a hiccup or the economy could, God forbid, imagine this, having a recession, a normal economic part of a cycle, the Federal Reserve must do something in order not to let that happen and keep stock prices up. And that is just a recipe for disaster. And, Jay, we may be wrong, and it may have to go 500 points higher or something, but when the downturn comes, like I said at the onset, it's going to be for a very long time. You can't sin for decades and expect to pay the price in a matter of just weeks or months.
Well, I don't disagree with that at all. Peter, we're almost out of time. I got to ask you within the next minute, a quick forecast on gold and silver.
We are close to a major triple bottom. We no doubt that less than a few weeks ago people had kissed it away. There was hard to find a bull. But until we get above the 50-day moving average and then the 200-day moving average, it's just a threshold. So to be conservative, wait for a close above the 50 and the 200-day. Probably that would be around 1,200 when it's all said and done. If we get there before the end of the year, we're going to see a credible rally. Everybody's short. Everybody's giving up on gold. We need to get above that to change and get the shorts out of the market. And if and when we do, I think we're on to march us back to the old highs.
All right. Well, thank you very much, Peter. We're out of time, unfortunately. I hope to do it again, though, sometime in the near future. Thank you very much for being with us.
Thank you, Jay.